Welcome to The Explainer. Today we are unpacking a reality that is honestly just mind-bending. We're looking at what is gearing up to be the largest initial public offering in human history, the SpaceX IPO, sitting at a staggering $1.75 trillion. To put that completely astronomical number into perspective, at a $1.75 trillion valuation, this company would literally be worth more than every single American defense contractor combined. We're talking bigger than Coca-Cola, McDonald's, Disney, Nike, and Starbucks, all tossed into the same bucket.
But that immediate, jaw-dropping scale brings up a really massive central mystery. Who exactly has the capital to actually absorb a valuation that colossal? I mean, who in the world is buying the most expensive IPO ever?
Well, the answer is you are. Yeah, whether you like it or not, within a few weeks of this listing, your very own 401k and passive retirement accounts are basically positioned to be the biggest buyers of this stock.
Let's just keep that target valuation of $1.75 trillion floating in our minds for a second. For an IPO to even make sense at this incredible scale, you'd probably assume the company has to be this flawless, perfectly humming machine, right? The ultimate success story that the public believes it to be.
Okay, let's dive into this because when you look a little closer, you have to juxtapose that massive valuation against this frankly staggering reality of $5 billion annual loss. I mean, how on earth do you square the biggest valuation in global financial markets with a company that's losing $5 billion a year? Well, to understand that, we kind of have to pop the hood and look inside.
Three companies in one, deconstructing SpaceX. If you ask most people on the street, they probably think SpaceX just, makes rockets for Mars. But it's actually a chimera. It's three very different businesses stacked right on top of each other.
Breaking down the projected 2025 revenue reveals a pretty huge disparity. Starlink is actually driving 61% of the revenue. The rockets, they're only 25%. And then XAI, alongside a few other segments, makes up the remaining 14%. The financial reality here is that Starlink, not the rockets, is the actual core driver of the company.
Let's briefly touch on that rocket division. It brings in roughly $4 billion in revenue. It launches satellites for the US government, hauls cargo for NASA. It's the famous face of the brand, and hey, it's a completely respectable business. But when you compare that to a nearly $2 trillion valuation, $4 billion in revenue simply isn't the main financial engine here.
Then we have the absolute crown jewel, Starlink. The numbers here are just incredible. In 2025, it brought in $11.4 billion in revenue, with 10 million active subscribers spread across 150 countries. And just look at those profit margins, 63%. That's up over 20 points in just 2 years. It is essentially the fastest scaling telecom in human history. We're talking an absolute cash printing machine serving everyday consumers, commercial airlines, maritime ships, and even the Pentagon.
So the crucial point is that these two solid businesses, Starlink and the rockets, actually brought in roughly $8 billion in profit combined. Now, that sounds like a fantastic foundation for a company going public, doesn't it? But there is a pretty disastrous twist. That $8 billion profit was reality right up until XAI entered the chat.
The XAI cash burn, lighting $1 billion on fire every month. We transition now to a definitely tougher part of the balance sheet. This recently acquired AI division basically acts as a financial black hole. It completely destroys the parent company's profit margins by, quite literally, lighting about $1 billion on fire every single month, which, let's be honest, is a pretty tough habit to budget for.
Now, what's really interesting here is when you look at the broader AI landscape, it reveals a sheer disparity in valuations. OpenAI generates roughly $24 billion in revenue and is valued around $850 billion. Anthropic makes over $30 billion and is valued at $400 billion. And then there's XAI. It estimates just $1 billion in revenue, yet SpaceX acquired it in an all-stock deal that valued XAI at $250 billion. That revenue-to-valuation ratio is just abysmal compared to the heavyweights.
And the internal metrics for XAI paint a really stark picture. Originally, it was founded by 11 heavyweights from DeepMind, Google, and OpenAI. But get this, by March of this year, every single one of those co-founders had walked out. The company burns over $1 billion a month, and it was even publicly admitted that XAI needs to be rebuilt entirely from the foundations up. The CEO of SpaceX essentially paid $250 billion for an asset that literally has to be restarted from scratch. Rewriting the NASDAQ rules. The red carpet. So, how exactly does a combined company, dragged down by an AI lab to a total loss of $5 billion last year, prepare for the biggest IPO ever? To answer that, we have to shift our narrative away from the company's fundamentals and look at the global financial system itself. Very conveniently, on May 1st, the Nasdaq quietly introduced 3 unprecedented rule changes. They effectively rolled out the red carpet, tailoring the entire system for a whole new class of companies, right in time for this expected IPO. Let's look at the exact steps they took.
First up is the fast entry rule. The old rule required a newly listed company to wait 3 months before joining the Nasdaq 100 index. This gave the market crucial time to figure out the actual price before passive funds were forced to buy in. The new rule? It compresses that entire wait time down to just 15 trading days. It basically skips true price discovery entirely to guarantee automatic demand almost immediately. Second is the free float minimum. Previously, you needed at least 10% of your shares available to the public to even qualify for the index. The new rule eliminates that minimum completely. And wow, does this perfectly accommodate SpaceX, which wouldn't have qualified 6 months ago because they're only targeting a tiny 4 to 5% float.
And this brilliantly illustrates the third change, the hidden multiplier. Buried deep in the technical language is a mechanic where Nasdaq now legally forces exchange-traded funds, or ETFs, to treat a company with a tiny float as if it were 3 times larger. So SpaceX's 5% float, it gets artificially weighted in the index as if it were 15%. Manufactured demand and the retail trap. When you bring all these pieces together, skipping price discovery, dropping float minimums, and artificially multiplying the share weight, you get what we call manufactured demand. The whole system is engineered to force buying. But the real question is, who ends up holding the bag?
Take a look at this absolutely shocking number. While normal IPOs typically allocate maybe 5 to 10% of their offering to everyday retail investors, SpaceX is targeting a massive 30% retail allocation.
Why such a high number? Well, SpaceX CFO Brett Johnson actually told a room full of bankers on the record, retail buyers have been incredibly supportive of us and of Elon for a long time, and we want to make sure that we recognize that.
But if we look past the whole corporate messaging, analysts point out a very different mechanic at play here. Early insiders, who are sitting on a very low-cost basis, are unlocking their shares to easily offload them onto passive, everyday retail retirement funds right at the absolute peak valuation. Basically, the buyers are forced in early by the new rules, and the sellers are unlocked later.
Portfolio manager George Noble delivered this stark quote that really just hammers the reality home. Your 401k is the exit liquidity. If you hold U.S. stock index funds, within a few weeks of this listing, your retirement account is literally absorbing the shares of this tech giant. You don't get a vote on it, and you don't get a choice.
So, the crucial point is what we can call the passive paradox. You know, passive investing is always sold as the smart, easy, set-it-and-forget-it way to invest. But that exact convenience is being weaponized against the investor. The very mechanism that makes it so easy for you is the exact same mechanism that automatically buys whatever gets forced into the index without even asking for your input. Which leaves us with this final, lingering thought. If the rules of the market can be quietly changed overnight to manufacture demand and legally force you to buy into a combined company running at a $5 billion annual loss, how safe is your passive index fund really? Think about that as you review your portfolios. Thanks for joining me for this explainer, and keep learning.